Welcome to the final section of our ASC 470 Debt Accounting course. This section brings everything together. We will compare US GAAP with International Financial Reporting Standards, walk through the most common mistakes practitioners make, cover the controls and roles your team needs, and make sure you are fully prepared for what auditors will ask for. Let's get into it. By the end of this section, you will be able to compare US GAAP and International Financial Reporting Standards for the most important debt accounting topics. You will know how to handle convertible debt under each framework, spot and prevent the errors that trip up even experienced teams, understand exactly who does what during close, and walk into an audit with everything ready. These are practical skills you will use every single reporting period. Here is the single biggest difference between US GAAP and IFRS for debt accounting, and it affects the income statement every single year. Under US GAAP, after Accounting Standards Update 2020-06, a convertible bond is recorded as one liability at its full face value. Simple. Under IFRS, governed by International Accounting Standard 32, you are required to split the instrument liability component at present value, equity component as the residual. That equity split creates a debt discount, and a lower carrying amount means a higher effective interest rate, which means significantly more interest expense flowing through the income statement under IFRS same bond, materially different profit. Let's make this real with numbers. Take a $1 million convertible bond with a 2% coupon and a 3-year term. The market rate for a plain non-convertible bond is 8%. Under IFRS, you present value the cash flows at 8%. That gives you a liability of roughly $841,000. The equity component is the residual, about $159,000. Year 1 interest expense under IFRS is 8% on $841,000, which is approximately $67,000. Under US GAAP, interest expense is simply 2% on $1 million, that is $20,000. The gap in year 1 alone is roughly $47,000. Watch out for this one if your company has operations under both frameworks. Most people assume the rules for covenant violation reclassification are the same under both frameworks. They are not, and the difference matters enormously at year-end. Under US GAAP, if you violate a covenant, the debt becomes current unless you obtain a waiver before the financial statement issuance date. You have time after the balance sheet date to get that waiver. Under IFRS, Revised International Accounting Standard 1 is stricter. If the violation exists at the balance sheet date, the debt is current. The waiver must be in hand by the balance sheet date itself, not the issuance date. A waiver signed on January 10th for a December 31st violation fixes nothing under IFRS. Check your framework before you finalize classification. Beyond convertibles and covenants, a few other differences deserve your attention. Both frameworks use the 10% cash flow test to decide whether a debt modification is a modification or an extinguishment. But IFRS 9 layers on a qualitative assessment. Even if the numbers come in below 10%, a substantial change in terms can still trigger extinguishment treatment. That is an added judgment call you will not find under US GAAP. On the cash flow statement, both frameworks allow interest paid to be classified as either operating or financing. US GAAP defaults to operating. Under IFRS, you make a policy choice and apply it consistently. And if you elect the fair value option, own credit risk changes go to other comprehensive income under IFRS. Under US GAAP, they go straight to profit and loss. Here is the key thing about interest expense. It is almost never just the cash you paid. The full interest expense calculation has 4 components: cash interest, plus discount amortization, plus issuance cost amortization, minus any premium amortization. Miss any one of those and your interest expense is understated. 2 additional traps. First, after Accounting Standards Update 2015-03, issuance costs are deducted directly from the debt balance on the balance sheet, not carried as a separate asset. The only exception is revolving credit facilities. Second, some teams expense issuance costs immediately. That is wrong. They must be deferred and amortized over the life of the debt. Both errors are common, both attract auditor attention, and both are preventable with a solid amortization schedule. Classification mistakes are surprisingly common, and they can misstate the balance sheet significantly. The two most frequent are forgetting to reclassify the current portion of long-term debt at period end and failing to assess covenant compliance at every close. Both require a maturity schedule and covenant calculation workpaper updated at every single reporting period, not just annually. Watch out for this one. Verbal assurance from a lender that a waiver is coming is not a waiver. The waiver must be in writing and signed before it protects your non-current classification. Similarly, if you are relying on a refinancing to keep short-term debt classified as long-term, you need a binding agreement, not just intent. Build all of these checks into a formal close checklist so nothing falls through the cracks. Two extinguishment errors come up repeatedly in practice. First, teams change debt terms, extend maturity, reduce rate, add a covenant, and skip the 10% test entirely. Any change in terms requires the analysis. No exceptions. Second, when debt is paid off, some teams only remove the face value from the books. That is incomplete. At extinguishment, you must remove the face value, every dollar of unamortized discount or premium, and every dollar of unamortized issuance costs. Leave any of those behind, and you have an asset that no longer exists sitting on the balance sheet, and your gain or loss on extinguishment is misstated. The gain or loss is simply the difference between the carrying amount you removed and the consideration you paid. Document it in a workpaper. Your auditors will expect it. Strong debt accounting requires clear role definition, not because people cannot be trusted, but because a second set of eyes catches errors that are invisible to the person who prepared the work. The team member does the initial identification, recording, and schedule preparation. When something requires judgment, an unusual classification, a borderline modification test result, they flag it upward. The team lead reviews everything: journal entries, work papers, disclosure drafts. Judgment calls get escalated to the manager. The manager approves all significant estimates and judgment-based conclusions and signs off before anything goes out. The key control principle here is that the preparer and the reviewer are always different people. Escalation is not a sign of weakness. It is how the control framework works. Let's talk about what auditors actually look for, starting with the two most foundational items. First, the debt register. Auditors will ask for a complete list of all debt instruments tied to the general ledger balance, with signed loan agreements supporting every single line. If there is a balance in the GL with no signed agreement attached, that is an immediate audit finding. Do not let it happen. Second, amortization schedules. For every instrument, you need an effective interest rate amortization schedule showing the opening carrying amount, the interest accrual at the effective rate, the cash payment, and the closing carrying amount, period by period. Auditors will recalculate your effective interest rate from the agreement terms. Make sure your schedule is based on the same inputs. Beyond the register and amortization schedules, auditors will dig into 4 more areas. Covenant compliance. They want signed compliance certificates, the underlying calculations, and written waivers for any violations, not emails. Signed waivers. Classification. They will test both the current portion calculation and the basis for keeping anything classified as non-current. Any debt that matured, was modified, or was extinguished during the period gets its own workpaper showing the 10% test results. And for payoffs, they want the payoff letter, the schedule of every balance removed, and the gain or loss calculation. Finally, most audits include a direct lender confirmation. A third party independently confirms the outstanding balance, interest rate, and collateral. Have all of this ready before fieldwork begins. A period-end checklist is not bureaucracy. It is your defense against the mistakes we have been discussing throughout this section. Run through 5 categories at every close. New debt. Confirm issuance costs are netted against the balance, the initial carrying amount is correct, and the amortization schedule is prepared. Interest. Confirm accrual through the last day of the period, all non-cash components amortized, and the total reconciles to the schedule. Classification. Maturity schedule updated, every maintenance covenant tested, violations identified, and waiver status confirmed in writing. Modifications and extinguishments. 10% test applied where needed, all related balances cleared at payoff, gain, or loss recorded. Finally, presentation and disclosure. Balance sheet net of issuance costs, maturity schedule complete, covenant disclosures current. Work through this list every single close. Before we close, let us step back and see the full picture. Debt accounting excellence comes down to 4 disciplines working together. First, know your framework. The differences between US GAAP and IFRS are not footnotes. They drive materially different numbers on the income statement and balance sheet. Second, build the controls, defined roles, segregation of duties, and clear escalation paths mean errors get caught before they become findings. Third, run the period-end checklist without exception, every single close, every category. Fourth, maintain your audit documentation continuously, not in a scramble when fieldwork starts. When these 4 disciplines are in place, debt accounting becomes a source of confidence for lenders, for auditors, and for management. That is the standard to aim for. Let us lock in the key takeaways from this section. The IFRS mandatory equity split on convertible debt drives significantly higher interest expense compared to US GAAP. In our example, nearly $47,000 more in year 1 alone. On covenant violations, IFRS requires the waiver by the balance sheet date. US GAAP gives you until the issuance date. Full interest expense is never just cash interest. It always includes discount amortization, issuance cost amortization, and any premium amortization. Verbal lender assurance is never a waiver, get it in writing and signed. And when your auditors arrive, they will expect a complete and tied-out debt register, effective interest rate schedules for every instrument, signed covenant compliance certificates, and work papers for every modification or extinguishment. Thank you for completing this section on US GAAP versus IFRS, controls, common mistakes, and audit readiness. Thank you for watching. Subscribe for more training from PNJ Group.